And if, as an investor in venture capital, you're looking for returns every quarter or every year, you're in the wrong asset class. This is a patient person's game.
How does one of the best software investment firms in the world feel about the SaaS apocalypse? Today's guest is Jeremy Levine of Bessemer Venture Partners. He has a long history of early prescient investments in companies like LinkedIn, Pinterest, Yelp, and Shopify. We sit down to discuss his firm's over 100-year history, how he lives in reality, and keeps his principles amidst everything happening in AI. He's the guy I turn to when the world is losing its mind. This is the Newcomer Podcast. Jeremy Levine, welcome to the Newcomer Podcast.
Thank you for having me.
Let's start big picture. You see it all at Bessemer and have watched a number of hype cycles. In venture capital, it feels like the haves and have-nots. There's the story of obviously all the AI mania, but then there also sort of has quietly been this downturn, the recovery from 2021 that's hit, some venture fund managers and then also a bunch of startups. I think we talked a couple of years ago now in light of that 2021 euphoria and the recovery. How do you see, where are we right now in sort of the venture capital cycle?
It's hard to know exactly where we are until we have perspective of being able to step back and look at it a number of years later. But that said, now I think it's pretty clear that 2021 was kind of the culmination of this incredible period of growth in SaaS, software as a service. The companies grew, the industry grew, the investors around the companies grew. Everything went up and to the right for many, many years, more than a decade. And then all of a sudden, the market thought for a minute, maybe these really nice businesses aren't quite as valuable as we thought they were. And that was the adjustment that we went through from 2021 to 22 or 23. And I think that's generally in the rearview mirror, save for the SaaSacre that has recently happened, which we should talk about in a minute. But I think the industry, the venture industry, the entrepreneurial zeitgeist, it all shifted to AI, obviously. And the growth of these AI businesses is making the SaaS stuff look like child's play. It's extraordinary. And so before software as a service, when a company had to roll out software, it had to build infrastructure, servers, and run all the stuff on premise, and SaaS made it so much easier that you saw SaaS companies go from 0 to 100 million of revenue in 5 years, whereas traditional software companies took 10 or more years. And that was this massive compression and acceleration. And now with AI, what used to take 5 years is now taking 1 year. And so it's an incredible speeding up of everything, which I think has the industry wildly excited, and it's fun to watch.
All right, SaaSacre, a word I cannot turn away from. You're a firm that had the Cloud 100 has been very loud on software, a big believer, vertical SaaS in particular. You guys were extremely strong. Yeah, what do you make of the public market's total turn away from software as a service?
Yeah, so at a high level, it's complicated and nuanced, and you really have to think about it on a name-by-name basis. But I'll nonetheless get myself in trouble by generalizing, and that is to say, I think the public markets have overreacted, very significantly in some cases. But there's also probably a little bit of valuation or price compression was meant to be. And so what do I mean by that? So for starters, I think the meme, if you will, is that with AI, anyone can create software. You don't need to be an engineer, let alone a really good engineer. And that drives the cost of creating software to near zero. And so why, as a company or a customer, should I pay a SaaS company to provide software for me when I can just build it myself almost for free? And I think that oversimplifies a lot of what a SaaS company does. But even if you take all that at face value, I think that's not what makes the most valuable SaaS companies really valuable. What the software itself, that is. What makes the most valuable SaaS companies really valuable is the fact that they grew a network effect. And so I'll give you a couple of examples. And the reason why the network effect is so important is because you can't replace it just by building the same piece of software for free. Perhaps my favorite example is Shopify. It was Alex Ferrara at Bessemer led the investment for us about 15 years ago. And at first, the software that Shopify made was just really good software. And that was their competitive edge. if that were their only competitive edge, I would be nervous for Shopify in the SaaSicer. I'm not. The reason why I'm not is because along the way, Shopify built multiple network effects that insulated its business from someone else just building the same software and giving it away for free at a cheaper price.
Right. But Shopify, it feels like a unique company. When I think of software companies, I think of them as sort of more than the aberration than the representative case. Like, do you have a view on Salesforce or a more classic software company?
So I think that the way I would analyze any given name, and we can go through a whole bunch of them, but Salesforce for starters, is like, is there a real network effect there? And I think in Salesforce's case, there are real network effects. I don't think they're quite as strong as the Shop Pay thing I was about to share with you, but they're real. And so a couple examples. One is Salesforce has built, or an entire ecosystem has been built around Salesforce of third-party consultants and integrators who've built products that plug into Salesforce. And so you can't just replicate Salesforce itself to get the value of Salesforce. You then have to replicate all the third-party capabilities that exist around Salesforce. And the reason why they exist around Salesforce and not other platforms is because Salesforce is by far the biggest. And so that's a situation where the first player, the first mover, has a massive advantage because the ecosystem develops around it. I think the second potential network effect around Salesforce is among its users. Its users are so familiar with it, and to the extent human salespeople remain a thing, that's a second source of value for Salesforce. There's so much comfort with it.
Design interface.
Absolutely.
Style.
And it makes them less efficient. It makes them less happy. Now that said, that is a network effect that could easily disappear if in fact salespeople writ large are replaced by AI, because AI doesn't care what the interface looks like. But I think that's what you have to do for each of these companies. Understand, is it just good software, or in some cases mediocre software, or is there something else going on? And if you ignore the something else, I think you're going to make the wrong call.
Do you have a view on what the valuation multiple of software companies should be? I know that's like a market-derived.
Yeah, and it really depends company by company. But I think ultimately, companies are worth some aggregation of their future cash flows. And so when these companies that have no profits are being traded for, say, 10 times revenue, I think what someone is really saying is, I believe this company will become profitable or quite profitable, and when I discount those future cash flows back to today, it happens to equal 10 times today's revenue. But I don't think they're saying there's something inherently valuable about the revenue itself that they're willing to pay 10 times for it. I think the math is implicit, and then people get lazy and they stop thinking about the future cash flows and just start thinking about revenue multiples. But I think as we, in 2021, we saw fast-growing software companies regularly trading for 40 and 50 times revenue, which implied extraordinary future growth and high profit margins. In some cases, that actually materialized. In some cases, it didn't. I think today people are willing to be a little less bullish about the future, and therefore that translates just to a lower revenue multiple.
Are you still investing in software companies at early stages, or is that thesis out the door now?
No, absolutely. And in fact, one of the reasons why is because what you're able to do now with AI embedded in your software is just so powerful. The functionality is fantastic. And I'll give you some examples. So we invested, it's probably been about 18 months now, in a company called Relevance. Relevance is essentially a software platform for managing AI agents. And so as companies adopt or try to adopt AI and want agents to do the work of oftentimes the grunt work that humans don't want to do, or supplement humans with additional capability, where these agents can run in the background 24/7 doing work to make people more productive, they need a platform to manage all this. And so that's what Relevance built. I'd say they were a little bit ahead of their time in that most people weren't really talking about AI agents 18 months ago or even 36 months ago when the company first got started. And today they are, and they're looking for solutions. And companies like Databricks and Confluent, as they try to embrace AI in their internal business operations, are all using Relevance for it. And so, yeah, there's certainly opportunities for software. Most of them are, I think, in today's world about leveraging AI and making it productive in the enterprise.
And to what extent are those like, we're going to have sort of a chatbot feature, or like where do you see them? I mean, there are a bunch of different strategies for replacing a software category with AI, or Do you have buckets that you're starting to see where it's like, okay, there's this approach, and this approach?
So we are seeing folks simply try to staple a chatbot feature onto a product. It's not going to work because the foundation labs, the foundation model companies, they have really great chatbots, and you don't need much else. You can just append them or open them in another browser. So I call that a very thin value proposition. The thicker propositions are ones that build real capabilities into the software. And so, for example, we have another portfolio company, Hockey Stack. Hockey Stack is a software company, also a relatively new investment, maybe 18 months old for us now. And Hockey Stack started off by building a data platform that you can use as a marketer to understand where your better leads are coming from, your worst leads are coming from. And when they first started the company, I don't think they had thought a whole lot about AI. Today, the entire company is geared around AI. And in many ways, it's sort of, back to our Salesforce conversation, flips Salesforce on its head. And so you could think of Salesforce as a tool to make human salespeople more productive, where the human salesperson is the engine or the brain of the operation, and that human is leveraging tools like Salesforce to make their job better. Hockey Stack has flipped the thing upside down, and Hockey Stack is saying, well, actually, there's so much data in sales and marketing that is hard for a human to intuit. And so wouldn't it be better if AI were the brain sifting through all the data to make decisions, and then when helpful, it will ask a human to do something. So the AI is researching the prospects, evaluating which prospects are the most ripe for potential sale, and then deciding what's the action that my company should take with respect to this prospect. And if it's reach out with an email, it will draft the email and have the human send it, or maybe even send the email itself. If it's have a conversation or make a phone call, it will tell the human, like, hey, this is a good phone call to make. And so the AI essentially becomes the quarterback, and the human is a tool that the AI is using to further the initiative. And so I think there's so many categories of software that need to be rethought or reimagined, because when they were designed, these AI capabilities didn't exist, and now they're wildly powerful.
What's your view on the big foundation model companies today? I have sort of conflicting intuitions. On the one hand, it feels like they keep doing better than we expect. Like the revenue is growing more. I think investors keep marking them up more and more. The sense that, wow, they're really dominant and highly valuable. I think that sentiment has continued to accelerate. I think people have seen some progress. You're investors, I think, in Anthropic.
Yeah.
And then on the other hand, I don't know, it feels very like thin and tenuous. You know, it's like, can OpenAI get all the money that it wants? It seems sort of desperate for more money. We saw XAI sort of clumsily merged into SpaceX in a way that didn't make me feel, from the outside, I guess, as optimistic about how that business was doing. What's your read? And I know they're all particular businesses with different strategies, but what's your read on sort of the value of foundation models and how much of the sort of the business opportunity here they're going to gobble up versus leave to other companies?
So I think that it's an interesting conundrum, because on the one hand, I heard somebody describe a foundation model as the fastest depreciating asset in human history. It goes down in value faster than a new car that's driven off of a new car dealership lot, which would suggest it's a really rapidly moving treadmill, and you're, as a model builder, you're sort of pissing money down the drain building today's model when you know it's going to be outdated in a minute. And I think that's largely true. However, and kind of amazingly, I also believe the good foundation model companies, of course Anthropic among them, and admittedly talking my own book, our own book a little bit on it, is going to be one of the most valuable companies in the world, because this stuff is so damn powerful. And credit to my partners who invested in Anthropic for us first a couple of years ago, and obviously that investment has improved in value more than our very recent investment. But I actually think the best investment in Anthropic on a risk-adjusted basis is the one that just recently happened at a $350 billion valuation, because it's become even more clear, or wildly more clear today, how successful this company has become and how much momentum there is for it to grow, because people just can't get enough of this stuff. And I'd say it's meaningfully penetrated certain sectors like software development, but it's barely scratching the surface of dozens of massive other sectors of the economy, including sales and marketing, or market research, or frankly, a lot of white collar, behind a computer office labor, where people are using it a little bit, but there's just so far for it to go. And you can just see that. I mean, I can't remember what's public and what I know in my head as private, so I won't share the data. But the financial performance of Anthropic is just, it's astounding. And so it turns out that while, yes, yesterday's model is much less valuable today than it was yesterday, a very small number of companies have proven the capability with the talent required to keep innovating and coming up with the next model. And it turns out that there actually are some pretty good uses for yesterday's model. It's maybe a little bit cheaper and a little bit less capable, but there are still plenty of people who are happy to use the slightly cheaper model for slightly less capability. And it's a really great business.
In terms of venture strategy and portfolio construction, like, have you said how much money you invested in Anthropic? I mean, there are firms, I know like the Menlo story a little bit better, where it feels like they put a huge percentage of their fund into Anthropic. Like, how have you thought about how much to say, all right, this is the thing, like put a bunch of money in it. Now we're growth stage investors by old school standards, versus saying, no, we believe in portfolio theory and we should have a bunch of different bets.
So we invest in across the full spectrum of
right. You do growth
companies.
Right.
We sometimes we write $100,000 check in a person with an idea on a napkin, and sometimes we write $100 million or even a $200 million check in what's obviously already a really compelling business. But what's in common across both is that we think the company that either barely exists or exists meaningfully can be 10 to 100 times larger in the future. And so, one can debate, is it easier to go from $1 million of revenue to $100 million of revenue, or to go from $100 million of revenue to whatever that would be, $10 billion of revenue? Is that right? 100 times 100? I think that's right. I think that's debatable. And so, and in fact, a $100 million revenue business actually looks like an early stage company relative to a $10 billion revenue business. And so we think it's pretty much the same skill or the same puzzle that we're trying to solve. But we're much less likely to invest in a quote unquote growth stage company, which may be a $100 million or even a $1 billion revenue business, if we don't think it can go 10 to 100 times bigger. We're not looking to make, a 2x return. That's much less compelling. And so I think what's remarkable about Anthropic in particular is that it's already at a very significant scale and still growing as fast or faster than any company we've ever seen. And so these things don't come around all that often. And so hats off to Menlo for making what I think was a very prescient early stage investment, but also I think a really smart later stage investment, because I don't see the ceiling on Anthropic even remotely on the horizon, which is part of why I think actually it's a better risk-adjusted bet at a $350 billion valuation, given all they've accomplished and all the risks that have been eliminated, than it was even a year ago when the price was much lower, but it had achieved much less.
I want to talk about agent marketplaces. Like, are you bullish on the idea that we should be building marketplace businesses for agents to interact with each other? We saw the Molt book sort of thing, which seems somewhat fake, somewhat real, somewhat fake. I don't know. It's still to be seen. But I don't know. What are you betting on any companies that are building like purely on a sort of agent marketplace thesis?
No. Well, I mean, I mentioned Relevance. Relevance is helping enterprises deploy agents to do white collar work. And so, yes, but a system for agents to talk to each other. We haven't invested in any pure play companies doing that, but we see it happening in some of our companies. And so, for example, if you want to buy a ticket to an event, you probably find your way to StubHub at some point. And StubHub historically found that most people who were starting the event search process would start it on Google or maybe on StubHub directly. And increasingly, they may start that process on Claude or on ChatGPT. And so they want to allow third-party agents to complete transactions. Same thing for Shopify across all its stores. If you're starting your shopping search process with a bot, every retailer wants to make sure its inventory is known to the bot. That said, I think it's going to depend a lot on what kind of transaction you're looking to do, because humans like choosing. While I might prefer to have a bot reorder my paper towels and toilet paper, I'm not really shopping around when I make that purchase. If I'm trying to decide which seat I might want to sit in the stadium, I want to see like what are the views, and I want to make the choice myself. And so I think depending on the category, we're going to find that in some instances we have the agents go all the way, and it's literally an agent to an agent transaction. And I think a purveyor of commodity goods like Amazon is going to find agent commerce really important. But in other places where taste and choice matters much more to the human, I think we'll have the agents do a bunch of work for us, but ultimately we're going to be the one who clicks the final, like, yes, that's what I want. I think these things are all emerging. I'll give you one other example, not to take this conversation in a random direction, but we invested in, I won't talk too much about it, it's a stealth investment in a wildly talented entrepreneur who's reimagining travel. And so in the way he described to me the pitch was so compelling, because he said, the internet, when it came along, it reformed travel, and it basically eliminated hundreds of thousands of people whose jobs were as a travel agent. But the internet didn't actually come up with a new travel agent. It just made you and me into travel agents. And we're now the ones checking what the flight options are, checking what the hotel options are, and kind of orchestrating it as a travel agent, which kind of sucks. But AI has the promise to actually be the travel agent and maybe live up to the original moniker, right? The Expedia and the Bookings of the world, they're called OTAs. That's the moniker, which stands for online travel agent. But in fact, they aren't online travel agents. They're booking engines. And maybe with AI, we can actually build an online travel agent. So I think the other thing that's interesting about all these sort of consumer agent technologies in particular is that the interfaces right now are all chatbots. But I think that's likely to be step one. And we're going to see wildly more creative interfaces that almost certainly will incorporate typing to a bot or even speaking to a bot, but also other elements that we're not yet seeing.
It will be amazing if they can build actual brands for delivering, the service successfully. Because I think right now, a lot of this agent stuff, it feels like, okay, it's going to put this in your checkout box, and then you're going to check out and say yes. And it's still like maybe it gets you closer to the final decision, but you're still like pulling the trigger. When we get to an era where like, okay, I've trusted this travel bot, it's booked it, now I'm willing to just sort of show up at the places it says, and I have a level of deference to it. I think that, will be a sort of an amazing
Maybe, although it depends. Like if it's a business trip and I know I need to be in, San Francisco at 2 p.m. on Thursday, like sure, let the agent do the whole thing. But if it's a vacation, like part of the fun is looking at the photos and deciding where to go. And so, like I said, I think the use cases are going to vary a lot. I think the simplistic idea that I'm going to do everything inside of a chatbot and I'm never going to go to a website anymore, that's ridiculous. But there will be definitely gradations.
All right. Is this a consumer company? Like it's for...
It is, yeah.
What is the state of consumer today? I know that's another big question, but obviously the foundation models, we sort of just talked through how in some ways maybe you're going to Anthropic or ChatGPT, Claude, and talking through the problem, and then they have to, have a relationship with StubHub or something, and the consumer experience is all in the chatbot. Is that the world you see, or do you see opportunity for AI businesses that build sort of direct relationships with consumers themselves?
I definitely see opportunity. So to step back, I would say there was an explosion of compelling new consumer companies between 1996 and 2005, the first couple of generations of the internet, and companies like Google and Pinterest and Facebook and the like all emerged. And then there was a second, slightly smaller, but still significant explosion of companies that happened around the development of the internet in your pocket on mobile phones, and companies like Uber and DoorDash all emerged.
People want a platform shift. Some new thing is happening.
It's not that they want it. It's not that they want it. It's that once a platform is established, the incumbents amass the power, and it becomes very difficult to get distribution. And so I think when people think about consumer, they assume it was like some new whiz-bang capability that built or was the foundation for a company. But in fact, while there often is a new whiz-bang capability, like being able to summon a car to you anywhere you are in your phone, that's Uber, what actually is much more important is how do you get that capability into the hands of millions or hundreds of millions or even today billions of consumers without having to pay to market to each one. Because if you need to pay to market to each one, your company will never be worth anything, but Google, who controls the internet platform alongside Facebook, or Apple, who controls the mobile platform, they'll make all the money, and you'll be stuck. And in fact, you'll have to raise tons and tons of money. And so if you I think most of those early generation internet companies, Facebook, Pinterest, Google, they never spent any money to acquire consumers. They got all the consumers for free. The second generation around mobile, it was a mix. Some did spend a lot of money, but actually, I also think they got a little lucky because they were built in this ZIRP era, the zero interest rate policy era, where they were able to get and raise billions of dollars very cheaply. If that hadn't existed, I think many of those companies wouldn't exist. But they do, and they did, and they took advantage of it, which was quite smart. And maybe the best and last example of a consumer platform that grew in the United States was TikTok, and they did it with billions of dollars of financing from a Chinese parent.
The money, right?
They spent the money. But most startups can't realistically access that capital. And so consumer becomes interesting when there's a new platform, because a new platform means there's a new distribution technique. And so I think right now there's a confluence of two things happening at once that make me quite optimistic that we will see some new consumer companies for the first time in a decade, maybe more. And those two things are, one, the way people are starting their internet experience was almost exclusively on Google or one of the Meta properties. And now there's like a new front door, and the new front door is Claude or ChatGPT or Gemini, the AI portion of Google search. And so the companies that had massively infiltrated the old front doors of the internet, like in travel as an example, it was booking. Like if you do any search on Google, like you see booking all over the results because they optimized the platform, and they became a $100 billion company that really dominates consumer travel. But for this new front door of the internet, which is a chatbot, it's like open season. And so I'm sure there's a team at Booking trying to figure out aggressively, like, how do we make sure Booking is as present in these chatbot results as they are in the Google search results. But it's like a brand new game.
Are startups doing well at that, or what's even the strategy?
And so, in the early days of search engines, it was how do we manipulate the search engines to show our stuff high up in the results. And there were companies like Yelp, which did it really well. And anytime you search for a restaurant in any city, the Yelp results were among the first results. That was essentially the Kickstarter for how Yelp grew. And so it became an entire art, or almost a discipline, called search engine optimization. And there's an equivalent of that discipline now emerging for this new platform. And like I said, we've seen lots of people trying to innovate or reverse engineer or think about how to build their business to take advantage of it.
Media. It's like one of the things that does well, I think, in these bots is media. So happy to have that leverage, I guess, at this point.
But the point is, it's a new channel, and it's very immature, and it's a sprint to go figure out how to crack this new distribution channel. So that's one. The second and compounding force is that there are new capabilities that you can build with AI that get consumers interested. And so now, just the latter is sort of more exciting from a principled perspective, because, like, do we need another travel booking engine? We don't. They work just fine, but there may be an opportunity for one just by dint of this new front door on the internet. If you can be the one who is right behind the new front door of the internet, you can build a replacement travel booking engine for booking. But the idea that you can build this wildly compelling new functionality because of AI makes it exciting. So now the consumers are also, in addition to discovering what's behind this new front door, are bumping into these new capabilities that I think will be sort of eye-opening or potentially jaw-dropping. And when you put those two things together, I think you have the conditions for new consumer companies.
The manipulation of the chatbots to produce sort of a company, I mean, it sounds somewhat depressing, right? I mean, I think what's great about the chatbots is, like, if I'm like, I want the best pan, like, what's the best pan? It's sort of like, well, here's the best expensive one, here's the best sort of medium, price one. Obviously, it's rooted in reviews and sort of different websites that trust, probably Reddit to a large degree. How much do you see these businesses as needing to sort of manipulate the chatbots versus accept sort of a paradigm where they're thinking about things in sort of a different way. I mean, we sort of saw the degradation of search over time, which has allowed some of this opportunity, which is just over time it got more and more sort of gamed and sort of, I don't know, degraded in my view.
If you want to think about it cynically, you can get pretty far just manipulating someone else's front door. And there were a lot of SEO companies that did that. I can't remember the name of the one that was, it was just like a massive farm of crappy content that would show up. It was called Demand Media.
Yep.
Eventually, the front door, the search engines,
one day they're like, no more.
Figured it out and like, this is crap. And they just killed it.
Right.
So you can get pretty far, but you probably can't build a great business. What makes a great business is that you may do some manipulation, if you will, these front doors to get your product in front of consumers, millions of them or billions of them for free. But then what makes your business special is that the product is awesome and the consumer's like, wow, this is great. And next time when they want that experience, they don't go back through the front door. They come directly to your service. And that's like the holy grail of consumer. And so,
are there any early businesses that have had success? I mean, I think Guillermo at Vercel tweeted at one point, that's not a broad consumer business, but tweeted that he was getting a fair bit of his business through people sort of deciding what to build in the foundation models. I don't know. Are you seeing companies where they're getting a lot of customers through these chatbots?
It's just beginning, but we are, and we're just trying to invest in them. So I'm not going to share the names with you because the last thing I need is even more competitors in a competitive world. But I'll give you an example of a company that we haven't invested in that I think has done this. It's a business called Suno. I don't know if you know Suno.
Yeah, the music creation.
Exactly. And so like the product is wildly compelling, and it allows you to do things that you could never do before, or at least most people couldn't do before. And I think they're also getting distribution through some of these chatbots. I think they're probably getting more distribution now because the product is so compelling. People are telling each other about it within the music world. But it's an example. Like, you have to build something that's good, or you end up going the ways of demand media. But like I said, if you have to buy all your consumers one at a time, you need to have a massive sugar daddy with billions of dollars to fund you, or you're never going to get there, and that's tough to do.
One, investor craze, and honestly, I can't remember if you made a bet in this category. The like QVC, the online shopping for video category. Did you make a bet in that space?
If we did, it was small and immaterial.
I don't know. Is that over, or TikTok won it to the extent it exists? I guess Whatnot is still sort of fighting it out. Do you have a read on that space? Because that was such like a hot category at one point.
Yeah, it's funny because I think that I'm not an expert on the Chinese internet, but my sense is that that's a much bigger it's a much bigger thing for Chinese consumers than it has been for consumers in the West. And I essentially think of there being two internets. There's the Chinese internet, and then there's the rest of the internet, and they don't mix very much. And so, and I don't know why. For whatever reason, no one has been able to quite make it work. But I wouldn't rule it out yet. I think we've seen a bunch of people try. Nothing has really stuck. I think Whatnot is interesting. I think it's a scaled business. My sense is a lot of what's happening on Whatnot are people buying things speculatively so they can resell them, and as opposed to buying things they necessarily want for themselves. So that's like a different phenomenon altogether. But I haven't given up on it. But you're right to point out it hasn't happened yet.
Yeah, I guess the gambling economy thesis. Are you staying away from that? I mean, it's clearly. I mean, prediction markets loom super large. I mean, yeah, I think you're correct that Whatnot is fueled in part by some of that same behavior. Yeah. Is that a thesis you've embraced?
So I think there are a lot of. If you're setting out to build a company, there's lots of companies you could set out to build. If you're setting out to invest in a company, there's a giant menu of companies you can invest in. And I think one of the criteria that I apply, that not everybody does, is I want to be proud of my association with the company. And so I'll give you like a classic example of a company that I admire the financial metrics on, but would never invest in because I just didn't want to be associated. And that was a company called Juul. You may remember that they made vaping pens. And by the way, people who invested in it early made phenomenal returns. It wasn't for me. And I think that when we look back on some of these prediction markets or gambling sites, there are a bunch of parallels that make me somewhat uncomfortable. That's not to say they aren't great businesses, and that's not to say someone else may not be a genius for investing in them, but they're not for me. And by the way, I happen to have 3 teenage kids, 2 boys and 1 girl, and I can see among particularly my sons and their friends, it sort of reminds me of Juul. It's like Juul is purportedly a smoking cessation device for adults, but you actually looked at who was actually using Juul with all its various flavors. It was like teenage kids. They're essentially introducing teenage kids to a new form of smoking, which was not good for those kids. And I think in many respects, these new prediction markets, which are allowing betting on anything all the time, I suspect one of their big customer bases are teenage kids who are particularly susceptible to the
Interesting.
addictive
I hadn't
characteristics
really
of
thought
gambling.
about the children angle.
Yeah,
They're not like gating it.
I think very recently they've introduced some KYC things, but which require you to prove that you're of a certain age. But if you ask any teenager about some restriction that was imposed on them by someone or something, I can pretty much guarantee you they have like 3 ways around it. And so I'm not sure how effective the KYC stuff is. I confess to ignorance. I haven't looked into it carefully. But even if it's a modest percentage of their business, it's just not something I would necessarily want to be associated with.
So you're staying away from like the whole theme.
I mean, I'm watching it, and by the way, maybe they find a way to eliminate that stuff entirely. And like if there were a Juul,
because you agree, prediction markets, which I agree in sort of quotes, which are becoming sort of sports gambling sites, are one of the major sort of consumer themes of the year.
Oh, they've grown enormously. Yes, no question about it. I mean, I think what held gambling back was all the regulation, and a couple of really sharp entrepreneurs found a loophole around the regulation where they can make it available to everybody instantly without having to go through any of the regulatory processes or reviews. And like, lo and behold, it's huge. So yeah, not surprising.
Do you think gambling was always in the crosshairs? I guess they did a good job of making it seem like elections and everything before it became about gambling.
Betting and like when people.
Sorry, I mean sports in particular.
Yeah, I mean, look, the difference, of course, as I understand it, is that they don't take a side of the bet. It's they're just matching bettors, so it's a marketplace, and that distinction.
You can just see the utility of like predictions in a way that predictions about sports don't. It doesn't feel like it have any utility.
Yeah.
Like what repricing the Vegas line,
Yeah, I suppose in certain instances, understanding what the world thinks on average about something is useful, but to whom other than a speculator? Maybe not so clear.
Any other categories or theses that you guys are really chasing at the moment?
Within consumer specifically?
Or no, consumer or more broadly?
So the other one that I'm really excited about is robotics. And so we, as I've talked about with you and others in the past, like we tend to be very roadmap oriented, where we try to build a hypothesis and test the hypothesis through experts about some change happening in the world. And oftentimes the most compelling ones are the simplest ones. And so, by way of example, 20 years ago, as we saw the consumer internet emerging, we thought like, oh, consumers are going to contribute content to media properties online, where the media properties have the benefit of being media companies without having to actually spend money on content. And that led to investments like Yelp and LinkedIn and Pinterest. And it was like a really basic idea. And once you have the basic idea, often an insight shared with an entrepreneur, you try to go find all the companies that are not competing with each other that are consistent with this idea. A really simple-minded, like one sentence view on robotics is that there will be probably 10,000 times, maybe even 100,000 times more robots on planet Earth 5 to 10 years from now than there are today. And there are essentially 3 big challenges in robotics. One is, can you make hardware that functions as a robot? 2 is, can you make the hardware move? They call that the locomotion problem. And 3 is, can you make the hardware manipulate things in the real world? And the hardware itself essentially works. There's tons of hardware. A lot of it is being made in China. Increasingly, companies are trying to make it in the US. So that was problem 1. Problem 2 is the locomotion problem. And now, as evidenced by Waymo, another recent Bessemer investment, like we can make hardware move without issue. It's solved, and you see it in robot dogs, you see it in autonomous cars, in all categories. And that was a machine learning problem, which is essentially solved. It isn't perfect, but it's close enough that it's usable. And the unsolved problem for robotics is around manipulation. So we have these things in the real world, but we need them to interact with objects to perform functions that in today's world, many humans do, but they're pretty crappy functions.
Fold laundry.
Yeah, I mean, that's the consumer one, but there's an enormous number of, I mean, there are many companies working on it, and they have various approaches to it. And I'm quite convinced that ironically, the LLMs of today have solved a bunch of what I think of as white collar type jobs before they've solved the blue collar type jobs. And in fact, an MIT professor I met with said to me the hard things are actually relatively easy in AI. Like AI can do PhD level statistics a hell of a lot better than I can. And yet the easy things, like picking up this glass, moving it here and moving it back without spilling the water, which is so easy for any human to do, is actually hard to do with AI. I believe it will be solved. And I can't tell you exactly when, and I can't tell you exactly what the path is. And so that is the basic thing.
I have a 4-month-old right now, and obviously babies spend so much time figuring out like, oh, how do I hold on to something that I think experiencing the human brain form, you're like, oh yeah, obviously it's a lot of work navigating the physical world. Are you bullish on humanoid robotics?
I think eventually
we wrote a big bear case. Just you don't have to agree with it, but we were somewhat skeptical in Newcomer about the humanoid form factor.
So I think it's fun for humans because it reminds us of ourselves. I think the autonomy of robotic form factors will be wildly varied, and there may be certain instances where the humanoid form factor is particularly powerful. I think it will come later because there are a bunch of challenges with humanoids that don't exist in other form factors of robots, but that it's not going to get in the way of these robots being wildly helpful or productive for humankind. And so anyway, so then the question is like, how do you invest in it? And we made an investment in a company called Foxglove. And if you believe there will be 100,000 times more robots, then we're going to need the same kind of infrastructure tooling for robots that we have for computer servers. And there's companies like Datadog that make some of the infrastructure tooling for computer servers, and we're going to want that same kind of capability for robots, and that's essentially what Foxglove does. It makes it very easy to...
And so then you avoid the particulars of which robot format is going to work.
It doesn't matter which robot companies or how they work, but if they have the leading solution for the underlying infrastructure so that the robotic makers don't have to go build this infrastructure software, they can just take it off the shelf, Foxglove should be a winner. So that's exactly right. So that's one area of investing. And then the second one is, okay, how do we figure out how to solve this manipulation problem? Once manipulation is solved, these robots become wildly more valuable to all of us. And so those are generally even earlier stage investing, oftentimes in academicians or inventors who are trying to solve this unsolved problem. And a bunch of companies who've raised billions of dollars. My general view is it is nice to have raised lots and lots of money so you can, pay people in Mexico to, mimic the behavior of robots and record it and collect all this data. I suspect the winner will be much more innovative than these companies using brute force to collect data. But it's early, and obviously I don't know for sure, but we're trying to find really smart innovators in this category.
I want to talk about venture capital as an asset class for a second. Bessemer as a firm has been investing for more than a century, right? Is that...
Yes, we came out of a family office, which has been, it's now, I think, since 1911, so 115 years.
I don't know. I think Andreessen Horowitz just published a piece like defending sort of the mega firm or scale in venture capital. What is your sense of sort of, the rise of like the mega fund and how venture capital is being practiced today? Do you think there is just sort of, you're a big multi-stage fund yourself. Like, how do you think about scale in venture capital?
I think scale is critical in venture capital. Does that mean it's required to have a successful fund? No. Do I think it's required to have a successful firm and a collection of funds? Yes. A bunch of things have changed even since I've been doing it. So I've been doing venture capital for 25 years. And 25 years ago, if you were an entrepreneur, you found out about venture capital and venture capital firms through word of mouth and some friends, and it was a little bit of an old boys network, and it was literally boys at the time. We've gotten wildly more diverse, thankfully, although it's still predominantly an old boys network. And therefore, having scale and building brand and marketing awareness and content, like none of that mattered back then. Because it was
now you're forced to come slum it on my podcast.
well, I mean, so now there's the internet, and people discover and learn in so many ways. And if your firm or your brand is only in the conversation 1% of the time, and someone else's is in the conversation 10% of the time, that's an advantage. And so I think there's this counter narrative, which I think is wrong, and that is if you want to have a 10x fund, it has to be a small fund because it's virtually impossible to have a 10x fund on a $3 billion fund. But if it's a $200 million fund, you could actually end up with a 10x fund. And I think that's right, except what it misses is all the $200 million funds that are going to be a 0.1x fund, and that if you have somehow the luck or prescience to invest in the $200 million fund that does become a 10x fund, good on you, but that's maybe as much luck as it is skill. Whereas if you want repeated sources of competitive advantage, you need scale and you need to be in the conversation all the time. And it's impossible to do that as a boutique firm with 4 or 5 people who do all the work themselves and have like zero
or you're
leverage.
leaving money on the table. Right? I mean, there's like, I sort of recently gave Benchmark a hard time in a story, which is they sort of have the brand and they're leaving it some of on the table by not investing in these later stage rounds. Like there are a couple firms, USV or whatever, that have built brands that if the reason you need scale is because you need to stand out in people's minds, there are firms that built brands that are smaller.
There are, but I would argue that the brands of the small boutique firms relative to the rest of the industry 20 years ago were much bigger, and they're increasingly smaller and getting crowded out by larger firms. But that's just one reason why scale matters. The second reason why scale matters is because timeframes to evaluate opportunities have shrunk substantially. 25 years ago, I might meet a company and we might get to know each other over months before they were ready to raise money or we were ready to invest in the company. Increasingly, that number of months is shrinking to days. And if you want to make good decisions, you have to arm yourself with meaningful data. And even for an early stage company that has 16 early trial customers, and like that's the whole business, you want to talk to 10 of the 16 to really know what's going on. And if you're in a small firm with limited resources, it's kind of impossible to do that in 3 days' time. Whereas a larger firm with more resources is going to have talked to every customer and 10 others to understand, like, is this an easy thing to sell and what do prospects think? And that's just an incredible information edge. And I've seen it recently, and I don't want to name names, but there was one instance where we were looking at it. It was a classic Series A investment, and I was working on it with several colleagues. And so we actually called every company that had its logo on this prospect website, and we found out that not a single one liked the product. And these were the logos on the company's website. And another really well-known, respected firm at a smaller scale than us ended up investing in the company because I think it was impossible. They had to sort of go on more faith and to kind of make a snap judgment on, like, is this entrepreneur talented, truthful, and so forth. And I think they made the wrong call. I think if they had the same data that we had, they would have made a different decision. And so I think there are it's not just brand and being in the conversation that scale gets you. It also gets you information.
Does honesty still matter? Or I feel like there's a nihilism. It came up sort of in the prediction market piece, but Yoni Reckman in my last podcast or in a recent podcast, described venture capitalists as sort of amoral financiers. Like, I guess you can be amoral and still think sort of honesty matters, but how much in this sort of world where, I don't know, people are playing pretty fast and loose, do you think it matters to back honest founders?
Look, do you want to be friends with honest people? Do you want to be married to an honest person? Like, that's a value judgment. I do, but like you can have your own values there. That said, I think more people than not resonate with people who do what they say what they do, are honest. And so I think, is it impossible to build a company as like a pathological liar? It's not impossible, but I think it's probably harder because it's harder to have loyalty and have people bought into the mission and so forth. But like I will say, there's also this age-old idea in Silicon Valley of faking it till you make it. And so could you fake it and have 15 fake-ish customers, raise a bunch of money, and then with that money turn things around? It is possible. It has been done, but it's not the kind of gamble that I want to take. And so it may well work out for this company that we didn't invest in, that now that they've raised money from a really well-known investor, they're going to use that to reform their ways and become a great company. But I'd bet against it.
One advantage you're saying you get with venture capital scale is you have, all these people running around and doing all this diligence. Do you still need all the people, or how much are you relying on analysts today versus using AI? I just published some research that Venture 5 had done, and they saw that analysts at venture capital firms saw their salary fall. Like, do you think you're hiring fewer of them because of what AI can do?
In the short term, no. But advantage 3 of a venture capital firm with scale is that we have the resources to invest substantially in AI tooling. And AI tooling is both a source of data. As a silly example, imagine if you knew anytime someone of a certain seniority level left Google and changed their LinkedIn profile to be stealth founder. Like, that's really valuable information for a venture capital firm to have. We have tooling that tells us that for every single person. If you're a little boutique venture firm with no resources to spend on tech and innovation yourself, you're not going to have that information. You're depending on your network to get you close to those people at exactly the right time. That worked really well when that's what everybody was doing. But now when there's a group of competitors who have access to this incredibly rich information generated by their own AI tools, you're at a disadvantage because they also have the same personal networks, but they have tooling on top. And so to date, we've used our tooling to make all of us more productive. And I would say we're in inning 1 or 2 in a 9-inning baseball game that probably even goes into overtime. So it's still early. But I have a hard time imagining in the short term the people in venture capital mattering less, because fundamentally companies are still run and founded by humans. And humans don't really want to interact with or build a partnership with an AI bot. They want another human. And so having people who are smart, ambitious, hardworking, and compelling as humans within our firm is really important, because those are the people who have to build relationships with today's founders and the founders of the future. Because fundamentally what we do is we become partners. Like it's why it's in our name, Bessemer Venture Partners, not Bessemer Capital, because we're looking to partner with these people in a very human partnership to help them through the ups and the downs, solve problems along the way, be the shoulder to cry on, be the person to bring them back down a little bit when they're celebrating a little bit too much. And those are all very human things.
If the venture capital industry is, inevitably booms and busts, overhype and underhype sometimes, where do you think we are in sort of, I don't know, I think we're still rooted in the .com story, but like, where do you think we are today in that sort of hype journey?
I think we are, it is cyclical, and the growth of AI and the emergence of these companies growing at faster rates and reaching bigger scale than anything we've ever seen before echoes to me the early days of the internet, the consumer internet, but the scale and speed is an order of magnitude or more bigger and faster. And so I think we are on our way up a well-justified hype curve. Now, much like in the early days of the internet, there were hundreds, if not thousands, of internet companies that failed. They had the wrong model, they had the wrong ideas, they were focused on the wrong things, but got funded in what was objectively a gold rush of sorts. We will see the same thing happening here. But I think much like some phenomenal companies emerged from the advent of the internet, like Google and Meta and many others, we will see massive companies emerge from this. And I think they will be even bigger than the ones that we saw in the internet. And so I think it's a great time to be investing. It's an amazing time to be alive. And I'm so curious what some of these things will actually evolve into. But nonetheless, venture remains the same, which is that it's a long game. And when we make an early stage investment today, on an idea like there'll be 100,000 times more robots in the future than there are now, that may not fully come to fruition for 7, 8, or 9 years. And if, as an investor in venture capital, you're looking for returns every quarter or every year, you're in the wrong asset class. This is a patient person's game. Even with these incredible momentum ideas like AI emerging. And so there'll be some instances where things just work immediately and it goes up and to the right and you can actually see and taste the value right away. Most of the time, it's a slow burn process until suddenly something appears to be really large when in fact it was growing a little bit along the way and just no one was paying attention to it.
Jeremy, thank you for coming on the Newcomer Podcast.
My pleasure. Thanks for having me.
Thanks so much for listening to the Newcomer Podcast. I'm Eric Newcomer. Follow us on Substack at newcomer.co. Hope you enjoyed the episode. See you next week.